Welcome back. My name is Arya, and I don't waste your time, so let's get straight into it. Ladies and gentlemen, we have a bit of an interesting video today because one of the stocks that I'm not going to say it was on the watch list per se, but definitely one of the stocks that is in the investable universe. I frequently tweet about it. It was in one of the videos that I made from a little while back. Reported earnings this morning, and the stock promptly fell 30%. Now, if you're new to the stock market, you might not realize this, but a 30% drop after any earnings for really companies of any sizes, even though this is a smaller market cap business, roughly about $10 billion, that's a pretty steep drop. That doesn't happen every day. Something must have gone terribly wrong within the earnings report, something thesis shattering. Maybe the company was trading at a very high valuation. Maybe the market was bidding it up a lot with anticipation and expectations of faster or accelerating growth in some cases. Something must have fell apart here. This doesn't, to the upside even, a 30% jump on earnings doesn't happen every day either. Hence why I wanted to make this video to kind of go through the report with you and see what exactly happened. But before we do that, I did want to explain what the company kind of does. They're like a work management, project management sort of software company. If you don't know what that means, don't worry about it. I didn't either. But actually, you can go onto their website by simply searching up monday.com, and they let you sign up completely for free. You get a 2-week free trial, no card required. Same as Fiscal AI, by the way. So if you want to, try out this magnificent software that I use to do all my fundamental research on, beautiful charting interface, all that great stuff. We'll get to that in a second. But yeah, so I just went on there, signed up. I have a 2-week free trial now, I believe. Set it somewhere here. And yeah, this is kind of it. So like, you would go into your home dashboard. And so for example, I chucked in a couple little tasks in here, make a YouTube video, edit the video, make the thumbnail. You can assign it to a certain person. You can leave a couple comments, make a good one. Let's update that. And so now we've left a comment there. Priority, we want it to be critical. We want it to be high. You guys kind of get the idea here, right? And then you could do like multiple projects. You could go to like a timeline view of like, let's see what is due when. There's integrations that you could bring in with Slack and all these other things in here. MailChimp from Intuit, Twilio, Stripe, LinkedIn, Google Drive, Google Calendar, right? So you guys kind of get the idea. Like it's to track the progress of your projects. And funnily enough, they say, and if you go over to their success stories section of their website, they share a lot of different stories of different companies that use them. But what I found most interesting was that even though they themselves are like a tech company, which I guess isn't that interesting, but 70% of their customer base is non-tech. So it's just all other types of industries. I found Oscar Health, which is pretty interesting. This one has gathered a lot of steam over on Twitter recently. And so they have like a customer success story of them. In a lot of cases, it's just like companies were previously kind of siloed in terms of tracking their projects and stuff like that. And there was no central way to do it. It's kind of an unnecessary software to have, unless, of course, you're like a much bigger organization and stuff like that. But yeah, it's just like, I don't know, it's just like any other software, right? Like you previously did it in like a more inefficient manner, and then now you have like an outright software dedicated to kind of use it and stuff like that. And so their plan structure is kind of like this. You need a minimum of 3 seats or 3 users to be able to do it. And then the plan structure is like pretty straightforward. The more expensive ones you get, the more actions and automations and dashboard and stuff like that you get. It's pretty standard stuff. But anyways, now that we have like a pretty decent understanding of what the business does, I'm going to jump over to Fiscal AI, which again, you could get 2 weeks free trial, no card required. By the way, when I say that, I feel like people think it's just a paid service. We have a great free tier as well with like a whole bunch of stuff. But I'm saying for the plan that you see me use in the videos, there's a 2-week free trial, no card required. But then in addition to that, once you have the account, you can, for example, track your portfolio. For example, this is my portfolio. And I have it tracked in like a nice little pie chart. There's weighted average statistics. For example, I know the weighted average forward PE of my portfolio is like 28. I could compare that with the S&P, stuff like that. So give it a try. Anyways, in terms of at least my digestion of like what went wrong with the earnings report, it's a simple case of revenue slowing down. And so I'll kind of show that to you. And the numbers haven't loaded in yet, because this is a foreign, they're I believe headquartered out of Israel. So revenue actually slowed down year on year, pretty significantly here. But again, they kind of like guided for this in Q1, so it's not exactly like a big surprise or anything like that. I think the bigger issues was that margins contracted a little bit, and then more importantly, we actually saw, and Fiscal AI is like the only place where you could get this granular level of data, but like there's like company specific KPIs for each company. And so particularly with Monday here, one of the big KPIs that I noticed that actually had a decline, and it's probably the most important, especially for like software stocks such as Monday.com, is the net dollar retention. And so this essentially tells you if we didn't get any new companies, because you know their customers are like just a whole bunch of different companies and stuff like that. If we didn't get any new companies to sign up for the software this year, how much would our revenue grow? And what that tells you is that like, you know, each customer becomes a little bit more valuable every single year, whether that be through more employees kind of joining the team and stuff like that, or like if the companies in of themselves, they upgrade to bigger plans, right? So that's kind of the main two ways that each customer becomes a little bit more valuable is you upgrade in terms of the number of seats, or you upgrade in terms of the plan that you're on. And so that across the company, it has been accelerating from like, you know, the past like 6-ish quarters, and that actually declined, even though it was only a 1% decline, but obviously like the trend of that isn't great. Now I should mention they do kind of break it out into the net dollar retention for like 10 plus users, net dollar retention for customers with 50K ARR, and net dollar retention for 100K ARR customers. So with the more valuable customers, these like three bottom ones here, those are much healthier net dollar retention rates, but obviously like it's not a good development for the business. So this was the first thing I observed that was like not the best. And then number two, and I would say this is like arguably even worse, they break out the number of customers they have with 10 plus users, and the growth of this has just been abysmal. And we saw a continued slowdown into this quarter. It grew only 8% year on year. And again, this kind of speaks to how they're going into a period of like slowing revenue growth as they've kind of gotten past the $1 billion mark in terms of revenue. Oh, another pretty important detail, but both the CMO and chief commercial officer, I believe, they both they got new CMO and CCO, and then they also acknowledged the Google search impact. The company acknowledged that some softness in the down market segment due to changes in Google search's algorithm, but believes this is temporary and is taking actions to mitigate the impact. So overall, like honestly, not that bad of a report. I just think like it's the accumulation of like all these different things kind of coming together and tanking the stock. I think the market is like a bit fearful of, and I'm just purely speculating here, by the way, because honestly, the report again was not that bad, but I think the market's just a bit fearful of like continued revenue slowdowns for this business, and is just like re-rating the company, which kind of brings me to my next point. We should touch up on valuation. They've now done roughly $1.1 billion of revenue in the trailing 12 months. As of the close, it was valued enterprise value of like $7.5 billion, and then they've done $1.1 billion in terms of revenue. That lands you, at a 6.8 EV to sales. And so if we go over back to fiscal and we look at the chart, obviously the IPO hype is like a bit overdone, but we look at, you know, like the more recent sort of history of the business, you can see that it's typically averaged around an 11 times sales multiple. And so now we are at around 6, which is pretty close to the lowest valuation the company has actually ever traded at. You know, there's been maybe like a few weeks where you've had the chance to catch it at below a 6 times EV to sales multiple. And granted, the revenue growth of the business has changed now, and they're guiding for slower revenue growth in the future as well. At that time, they were growing like 50% year on year and still trading at that multiple. But at the same time, like they were diluting a lot more back then, and they weren't as profitable. I'm actually curious to know what their free cash flow margins are now that we're here. Wow. They're actually pretty profitable. They have 40% free cash flow margins, and then obviously they're like kind of ramping free cash flow as well, which is nice to see. So yeah, back then obviously they didn't have as much profitability, and now they do. And so overall, like I definitely like what I'm seeing. It's a pretty cool company. I like the space they're in. I'm not too sold in terms of how sticky the software actually is. I'm sure it's sticky like for businesses that actually need it, but it's not like, I feel like it's not super mission critical. And if you're a long-term viewer of the channel, I used to own this company Paycom, which I sold for Google, and Google has underperformed since. But anyways, this is like similar market cap, by the way. And so this is a HCM. It's like HR software and like onboarding and all that type of stuff. Paid time off, payrolls. It's like that sort of software, which is like, again, it's stuff that businesses need, sure. How sticky is it? How mission critical is it? Like, not that mission critical. I would rather, if I was to buy a software business, I'd rather buy something like ServiceNow or something like, even though like I don't like the lack of growth with the business, I feel like something like Salesforce has a much wider moat, and I feel much safer being an owner of that type of business. Again, I'm probably not going to be buying Salesforce anytime soon, just simply because like this revenue growth is abysmal, and I don't see it changing anytime soon. Do I still think it's like undervalued at the price that it is now? Like, yeah, probably. I think it trades at what, like 16 times free cash flow, 17 times free cash flow. Yeah, 17 times free cash flow. Anyways, to answer the original question, like, I probably won't be buying shares of Monday. I do think it's a pretty cool company. I do think the stock can probably work from here. Again, we went through the report. Like, there's not anything like alarmingly bad. They told us at the start of the year that revenue would slow down. That was the expectation. You know, companies that ramp profitability, their revenue growth probably slows down as they focus on that more. That's just kind of a given. So I'm not sure who we're surprising here with the 25% revenue growth. That's kind of what they gave us in terms of guidance. But anyways, I'm not sure where the mismatch was in terms of expectations and the results of the business. I do think it's probably undervalued though. Not financial advice, of course. With that being said, thank you very much for watching. Leave me comments, by the way, if I missed anything, because this isn't a business that I've like analyzed super in depth. But yeah, if you want to just kind of chat about it in the comments, I read and respond to all the comments, like always. So by all means, if you want to chuck some stuff down there, I'd be happy to kind of talk with you. Other than that, thank you for watching and have a great day.